Jay Tambe, emerging market corporate debt has gone from about $4 trillion in 2004 to over $15 trillion now, and we're seeing some defaults. But before we talk about the defaults, how did we get that big?
Several reasons. One is you had a flight from low-yielding economies because of our monetary policy, so people went looking for yield. You had a period of great expansion. You had a number of countries, China and the countries surrounding China, which really rode both the China boom and the commodities boom. These were attractive places to invest, and it was relatively easy for companies in that part of the world to raise debt without paying a lot in terms of interest rates. It was an attractive proposition for investors, and it was attractive for issuers.
All right. How much of this 15 or more trillion in emerging market corporate debt is from China, and what's the quality of it?
So from China, I think by some estimates, it's about 60%. So that's a big number devoted solely to China. The quality is a very good question. And one of the tough things about China typically is you cannot really judge the quality the way you would for most companies in the West, most companies in Europe. And that's a big question mark. And that leads to some concern and might lead to some problems down the road.
You do know when you're not getting a coupon, though. So can you talk about the defaults we're seeing right now? Right. Which sectors are you seeing them? Yeah. Which countries?
So as you can imagine, the sectors you're seeing them in are commodity-focused and China-focused. So you're seeing them both in China from companies that have exposure on the commodity side and the real estate side, but you're also seeing it in countries like Indonesia and Malaysia, Thailand, with companies that had raised capital to help the Chinese economy effectively. When China slows down, these economies slow down. Again, it's the commodity sector, probably first and foremost, where you're seeing the defaults.
Will this cause China to devalue their currency? Because if you have more currency out there, more inflation, it's easier to pay back your debts. So will this trigger that devaluation that everyone's afraid of?
You know, that's an interesting question, because one of the phenomena here is that a lot of this debt, not all the 15 trillion, but a lot of it is dollar denominated and it's euro denominated. So the currency devaluations that have been happening, for example, in Indonesia, Malaysia, et cetera, have actually been hurting the borrowers in those countries. And you do have a fair amount of dollar denominated debt that's come out of China. So it might seem like an obvious answer to say, well, you devalue your currency and that helps you pay off your debt. Maybe not. If you have a lot of dollar-denominated debt, that's a problem.
All right, so what should U.S. investors know about their emerging market holdings? Should they ask their portfolio manager, do you have any Chinese debt? And if so, sell it. What should we be doing?
Well, investors need to know what they have, right? And you'd be surprised where emerging market debt, including China debt, shows up. It shows up in a lot of different types of bond funds. There's some that are specifically focused at emerging markets, but even broader bond funds have higher yielding debt from the emerging market countries. And a lot of investors, frankly, may be surprised to see that they have that kind of exposure. So knowing what you have, making a decision about whether you can take that risk, because it is a risk and it's a growing risk in our view.
And how big a risk is that this could bring down the global economy? We're talking about over $10 trillion here.
Right. So the interconnections to the global economy, you would think, 8 years after the crisis, we've got it figured out and it's all mapped out. It's not. It's as murky as ever. And you remember back in 2007 and 2008, one of the big concerns was we didn't know where the risk ultimately rested. We have some of the same issues today. The debt is held in ETFs, it's held in mutual funds, it's held by asset managers. It's difficult to quantify, it's difficult to calculate in one place. And so what are the interconnections? They exist. How big they are and how bad they are, we're going to have to find out the hard way.
Do the ratings agencies have a clue? Because they didn't have a clue the last time when it came to the mortgage bonds.
So not all of this stuff is rated, right? So some of it is in fact rated by rating agencies that we're all familiar with. Other stuff is shadow rated, or it's simply loans that have been extended by banks, and then those loans have ended up in CLOs and other products that are sold to investors, institutional investors in the West. So not all of it is rated. And one could ask a fair question about how up-to-date those ratings are.
Should we be hearing about this when the Fed meets? Because they're certainly not relying on the People's Bank of China to inform them.
We should be. And so where are we hearing it from? We're hearing it from the IMF. Big report in October of last year. We're hearing it from the Bank for International Settlements. Big report at the end of December. They're quantifying this, and they're raising their voices and saying people need to be focused on it. Central bankers need to be focused on it. The Fed should be focused on it. It has an impact. So when the Fed takes action, for example, if the Fed raises rates, that is going to have an impact on this emerging market debt, and a bad impact. We saw a little bit of this in the taper tantrum, where you had huge outflows out of high-yielding debt, including emerging market debt. You're likely to see that again. So that has an impact on what the Fed does.
Thanks a lot, Jay Tambe.
Thank you.
And thank you for watching The Street.